Good evening from New York. It's 5:54 p.m. on Thursday, April 9th, 2026. Welcome to the Lynx Data Insight Market Briefing. This analysis is AI generated by Lynx Data Insight and is for informational purposes only. It does not constitute financial advice. Markets are now closed, and we had a second consecutive day of gains, but the story underneath the surface is considerably more complicated than that headline suggests. Walk us through the numbers.
The numbers tell a story of cautious optimism layered on top of genuine geopolitical fragility. The S&P 500 closed at 6,823.94, up 0.61%. The Nasdaq led at 22,819.30, up 0.81%. The Dow gained 0.57% to 48,182.57, and notably, that index just turned positive for 2026. The Russell 2000 gained 0.60% to 2,636.21, so broad participation, not just megacap driven. The advanced decline ratio confirms that, 354 stocks advancing versus 158 declining. The VIX sits at 19.48, still elevated, not panic but not complacency either. On the rates side, the 10-year Treasury is at 4.29%, the 2-year at 3.59%, giving us a 70 basis point positive yield curve spread in a normal configuration. The primary driver remains the fragile 2-week ceasefire between the U.S. and Iran, with secondary catalysts from an AI spending blitz, Amazon's shareholder letter, Meta's CoreWeave deal, and Google's expanded Intel partnership. But here's what makes this session so telling. Crude oil surged above $100 intraday before settling at $97.87, according to CNBC, after Israel agreed to negotiate with Lebanon. The market rallied even as oil climbed. That's a tension that doesn't resolve itself quietly.
That oil move is the one that should make people uncomfortable. Walk us through the ceasefire dynamics, because the ADNOC statement today was striking.
It was the most important statement of the day for anyone managing commodity risk. Sultan Ahmed Al Jaber, the CEO of Abu Dhabi National Oil Company, said explicitly, and I'm quoting, "The Strait of Hormuz is not open. Access is being restricted, conditioned, and controlled." He called it coercion, not freedom of navigation. That matters because the ceasefire was predicated on Iran reopening the strait. Iran technically agreed to allow passage for 2 weeks, but in practice, ships must obtain Iranian permission. Only some bulk carriers carrying dry cargo have passed through. Oil tankers have not. Meanwhile, according to CNBC, Iranian attacks on Saudi pipeline infrastructure and the Manifa and Khurais production facilities have slashed the kingdom's output by a combined 1.3 million barrels per day. Kepler analyst Matt Smith told CNBC that Gulf producers have shut down approximately 13 million barrels of production due to the strait disruption. So you have a ceasefire that theoretically de-escalates, but the physical supply picture remains extraordinarily tight. WTI settled at 97.87, Brent settled at 95.92. The pullback from above 100 was entirely driven by Netanyahu saying Israel would negotiate with Lebanon, which eased the immediate threat of ceasefire collapse. But the underlying supply deficit hasn't changed by a single barrel.
And while that was playing out in energy markets, we had a massive day for AI capital commitments. Amazon's letter felt like a watershed moment.
It was the most substantive defense of AI spending any hyperscaler CEO has delivered. Andy Jassy disclosed for the first time that AWS AI services have reached a $15 billion annual revenue run rate. Amazon's custom chip business, Graviton, Trainium, Nitro, is at a $20 billion run rate, growing triple-digit percentages year over year. And he explicitly defended the approximately $200 billion 2026 CapEx plan, saying, quote, "We're not investing on a hunch." He pointed to an over $100 billion commitment from OpenAI and said Amazon already has customer commitments for a substantial portion of the planned spend. The stock responded. Amazon closed at $233.65, up 4.08% on the day. On a 5-day basis, it's up 11.38%, trading well above both its 50-day moving average of 213.50 and its 200-day at 224.73. Year to date, it's up 3.16%. That's a name that's broken back above both key moving averages and is showing genuine momentum. And Amazon wasn't alone. Meta committed an additional $21 billion to CoreWeave on top of a prior $14.2 billion arrangement extending through 2032. That's $35 billion in total committed to a single infrastructure provider. Meta also unveiled Muse Spark, its proprietary AI model, a sharp departure from the open-source Llama family. The pivot to proprietary signals that Zuckerberg has concluded open source alone won't generate new revenue streams against OpenAI and Anthropic.
But Meta's stock barely moved, up only 0.2%. That's a pretty tepid reaction for $35 billion in commitments and a new frontier model.
You're right to flag that disconnect. Meta closed at $628.25. It's trading below both its 50-day moving average of $634 and its 200-day at $682. Year to date, it's down 3.3%. The 5-day return is strong at 9.39%, but that's mostly the Wednesday bounce. The market is telling you it wants to see monetization, not more spending. Advertising was 98% of Meta's $200 billion in revenue last year, until Muse Spark demonstrably improves ad targeting or generates API revenue. Investors are treating incremental capex as a drag, not a catalyst. Contrast that with Google's move, expanding its Intel partnership for multiple generations of Xeon 6 CPUs in AI data centers. Intel surged 5.06%. Google closed at $318.45, up 0.95%. What's structurally significant about this deal is the acknowledgement that CPUs are becoming the bottleneck in agentic AI workloads. NVDA's own head of AI infrastructure said so much in March. Intel's CEO framed it perfectly. Scaling AI requires more than accelerators. It requires balanced systems. Google is up 7.68% over 5 days, trading above both its 50-day at 308.60 and its 200-day at 267.50. That's one of the healthiest technical profiles in the Magnificent Seven.
And let's connect these threads to the rate picture, because with oil near 100 and PCE running hot, what does this mean for the Fed?
This is where the cross-asset picture gets uncomfortable. The February PCE data released today showed headline inflation at 2.8% annually, with a hot 0.4% monthly reading. Core PCE edged down to 3%, but remains well above the Fed's 2% target. Personal spending rose 0.5%, while income dipped 0.1%. Consumers are drawing down savings to maintain spending, with real disposable income falling 0.5% month over month. That's the kind of data that historically precedes a pullback in discretionary spending. Now layer on oil near $100. The 2-year yield at 3.59% tells you the market is pricing the Fed's funds rate to stay approximately where it is, no imminent cuts. The 10-year at 4.29 with a 70 basis point spread says the term premium is modest and the curve is normal, but there's no room for the Fed to ease. Here's the critical nuance. The Fed typically looks through energy shocks unless they contaminate core inflation or inflation expectations become unanchored. Oil at 98 doesn't automatically mean rate hikes, but oil at 98 for 2 or 3 quarters, with services inflation already sticky at 3% core, starts to bleed into airline costs, shipping costs, food production costs. The transmission mechanism runs through jet fuel surcharges, fertilizer prices, and freight rates, all of which filter into core goods and services with a 3 to 6 month lag. A summer rate cut is now effectively off the table. The Fed holds through at least the summer, and if the Strait situation doesn't resolve, we could be discussing whether the next move is a hike by autumn.
So who are the clear winners and losers in this environment?
Let's start with the cyclical winners. Constellation Brands surged 8.02% after Q4 earnings beat, $1.90 versus the $1.74 estimate, and beer depletions turned positive. Brown-Forman jumped 14.10% in a sympathy move across the beverage space. Carrier Global gained 5.80% on industrial rebound tied to ceasefire optimism. Lululemon added 5.72% as consumer cyclicals caught a risk-on bid. Intel, as we discussed, rallied on the Google partnership, and Amazon led the megacap charge. Structurally, the two strongest sectors by breadth are utilities and energy. Utilities have 87.1% of stocks above the 50-day moving average, 83.87% near their highs, and 0% near lows. That's extreme defensive strength combined with the AI power demand narrative. Amazon just said it would cover all expenses for new energy infrastructure and grid upgrades in Mississippi. Energy has 81.82% above the 50-day, 95.45% above the 200-day, and 0% near lows. Basic materials also shows 0% near lows with 70% above the 50-day. Now the losers. Technology had 6 of the top 10 losers today. Datadog fell 8.17%, CrowdStrike dropped 7.35%, ServiceNow lost 6.97%, Palantir declined 5.87%, Autodesk fell 5.21%, and AAPL Systems dropped 5.06%. The common thread is Anthropic's Claude Managed Agents launch, which is directly attacking enterprise SaaS functionality. The software ETF fell nearly 1% on an otherwise green day. Texas Pacific Land, an energy royalty company, dropped 15.44% despite elevated crude. That's profit-taking after an extended run. And here's what the narrative misses. Healthcare has the weakest breadth in the index, only 26.67% above the 50-day moving average, just 10% near highs. Consumer cyclical is similarly weak at 32.08% above the 50-day. And technology itself, the largest sector at $19.35 trillion in market cap, has nearly 1/4 of its stocks, 24.69%, near 52-week lows. The AI infrastructure winners are masking a quiet deterioration across the rest of the sector.
That tech bifurcation is remarkable. Nearly 1/4 of tech stocks near their lows while the sector headline looks fine. What's the risk case investors should be stress testing right now?
Our base case, which we'd assign a 55% probability, is that the ceasefire holds in fragile fashion. Equities grind sideways to modestly higher in a range of 67.20 to 69.20 on the S&P 500. The 10-year oscillates between 420 and 440. WTI stays between 92 and 102, and the Fed holds through the summer. The causal chain here is ceasefire compliance, even imperfect, gradually normalizes some straight traffic, which caps oil below 105, which keeps headline inflation from spiraling, which keeps the Fed remain patient, which keeps equities supported near current levels. The risk case, and I'd assign this a 30% probability, is a ceasefire collapse. The trigger would be Iran retaliating for Israeli-Lebanon strikes or formally reclosing the strait to all traffic. The ADNOC CEO's statement today suggests we're closer to that scenario than the headlines imply. If the strait fully closes again, we lose the 13 million barrels per day that are already shut in. Saudi infrastructure damage compounds the problem at an additional 1.3 million barrels per day. WTI pushes to 115 or higher. The 10-year yield spikes toward 450 as inflation expectations overwhelm any flight to quality bid, and the S&P 500 reprices toward 6,400. That's roughly a 6% drawdown from here, concentrated in consumer discretionary, airlines, and energy-sensitive industrials. The causal chain runs strait closure, oil spike to 115, jet fuel and fertilizer costs surge, airline margins collapse, consumer spending contracts as gasoline prices rise, discretionary earnings estimates get slashed, and the Fed faces a stagflationary dilemma. The upside tail, at 15% probability, requires Iran to fully reopen the strait to unrestricted commercial shipping and a broader peace framework to emerge from the Vance-led negotiations in Pakistan. That scenario crushes oil toward 80, collapses the geopolitical premium, and could push the S&P 500 toward 7,100 as pent-up confidence unlocks.
Given those scenarios, how should investors be positioned?
Highest conviction. Maintain overweight energy producers, not royalty companies like Texas Pacific Land that just corrected, but integrated producers and pipeline operators that benefit from sustained elevation in crude. The breadth data confirms this is not a single name story. Secondary conviction, utilities, held structurally. The sector's breadth is the strongest in the index, with 0 stocks near lows, and the AI power demand story is now explicitly funded by hyperscalers. Amazon, covering grid upgrades, is a direct subsidy to utility earnings. Tactical. If the VIX pulls back below 18, consider put spreads on the Nasdaq to hedge the SaaS deterioration, which is structural, not cyclical. Anthropic's Claude-managed agents launch is a competitive threat that doesn't go away with a ceasefire. Avoid list. Rate-sensitive consumer discretionary. That sector has only 32% of stocks above the 50-day moving average, with elevated fuel costs squeezing margins and real disposable income already falling. Also, avoid enterprise SaaS names until the competitive disruption from AI agents is better understood. Healthcare deserves scrutiny too. At 26.67% above the 50-day, there's broad internal deterioration that isn't getting attention.
So, how does it all fit together?
When you step back, this is really about a market trying to price peace while the physical world delivers war. Equities are rising on ceasefire hope, AI capital commitment validation, and broad advanced decline participation. But oil near 100, a strait that's still functionally closed, Saudi infrastructure losing 1.3 million barrels per day, WTI running hot with consumers spending down savings, those are the ingredients for a regime where good news on geopolitics is necessary just to prevent a correction, not sufficient to fuel further upside. The AI spending story is real. $15 billion in AWS AI revenue, $20 billion in custom chips, $35 billion committed to CoreWeave. But it's creating a two-tier market where infrastructure beneficiaries thrive and software incumbents face existential competitive pressure from AI agents. The bull case deserves respect. If the strait reopens fully, oil collapses, inflation expectations reset lower, and the Fed gets room to consider normalization, that's a path to 7,000 on the S&P. Dismissing that outcome entirely would be as dangerous as ignoring the risk case.
Give us 3 takeaways to close.
First, risk management. The ADNOC CEO told you today the strait is not open. Don't let 2 consecutive green days obscure the fact that 13 million barrels per day remain shut in, and the ceasefire has multiple violation claims against it. Position sizing should reflect a 30% probability of escalation. Second, market insight. The technology sector's bifurcation is the most important structural signal in this market. Anthropic's Claude-managed agents launch is accelerating the divergence between AI infrastructure winners and software casualties, with nearly a quarter of tech stocks near 52-week lows, even as the Nasdaq gains. Third, positioning. The highest conviction trade remains energy and utilities as a barbell. Energy for the geopolitical premium, utilities for the defensive floor, and AI power demand tailwind. Gradually reduce SaaS exposure over the next quarter and use any VIX compression to add downside hedges.